What we now have is a fairly seminal report put out by Morgan Stanley. The report comes out with expecting some major dramatic changes in the Indian economy, and I'll read out some of the big things that this report believes the economy can achieve. Economic growth to average 6.75% over the next 10 years. Remember, the last number we have is 4.3 or 4.5. India to supply 25% of the increase in the global working age population by 2025. By 2025, India's size of the economy to more than double. We are at the moment less than $2 trillion, expected to become $5 trillion by 2025. That's 10 years from now. Domestic savings allocated to equities should aggregate $230 billion in the coming 10 years. And so the market cap itself is expected to touch $4 trillion by 2025. So a fairly long 10-year bull run expected in the markets and in the economy. The author of this seminal report is with us, Chetan Ahya, Managing Director, Chief Asia Economist at Morgan Stanley. Chetan, all this because of a stable government?
Well, I think it's more than that, in the sense that we think that India does have a very strong structural story. So we've highlighted in the report 3 key factors. First is that we have good demographics, and it's not just demographics, we've got talent as well. Our analysis shows that we now have 210 million youth literate level people. 6.5 million tertiary graduates annual outturn. So demographics, that's the first one. Second is reforms. You can have good talent, but you need to have the platform for working age population to work, and that's where we think reforms have played a role. Reforms have been happening gradually. Sometimes there have been pauses, and yes, there's an assumption that the stable government will come through over the next 10 years and deliver those reforms. And then finally, it's globalization, which is that India's trade to GDP has more than doubled over the last 10 years, and that has played a big role in improving productivity dynamic and then also supporting the growth rate. So we're just actually very conservative. Last 10 years average is 7.6%. So there it is. Okay. 6.75 is actually, I would say, a very much achievable number. Yeah,
I agree. 7.6 when you look at it, but 7.6 were also those irrational exuberance years where so much global capital came in. It is exuberant when you look at the last 2 years of GDP growth. Right. Sub 5% FY14 is ending in. What is the sense with FY15 itself? Is that going to see a turn, or have we to wait a couple of years to reach anywhere near 6%?
Well, I know that you guys are very focused over the next 2 quarters, but let's accept it. I think what the outcome of elections should be evaluated is more in terms of what happens in 2 years' time. Absolutely. So I think it's that certainty of being able to forecast a decent recovery going forward in the next 2 years is what is critical. And don't forget that inflation is as critical. The key reason why investors didn't make money, whether you talk about domestic investors or foreign investors didn't make money, is because we had 10% inflation. So if we get a Goldilocks kind of environment visible in the next 2 years, which we think it is, then that's what you should focus on. But to then answer your question, the next 2-3 quarters, we are only focused on whether the recovery is visible. The numbers will still be pretty weak. So March 15 quarter, we are looking at 5.5, 5.6 kind of number for GDP growth. But in the next 2 quarters, you will still have some kind of weak numbers below 5.
This Goldilocks environment 2 years down the line, or this big break, this tectonic shift, as some other research reports have called it, is expected maybe 2 years down the line. Right. But the immediate, next 3 quarters, forget growth. I mean, even if you see that crawling up, how are you looking at inflation? Are you seeing it moderating at all? Because even the last number in CPI is 8.6. There is a small likelihood, at least, of food inflation continuing because of El Nino. And fiscal deficit, which is the big reason for this huge inflation, doesn't seem to be going away this year itself.
Yeah, absolutely. I do think that there is a problem, that in the near term inflation is going to be a challenge. And I would also highlight one other factor on that front, that it's wages. I think it's very much underestimated because national rural employment was a pet scheme of the previous government. Nobody really criticized it. But in a country like ours, you cannot have such a strong wage growth when you have a huge level of underemployment and unemployment. It's actually counterproductive. So that was the key reason why we had food inflation and why we have high inflation. So That is also a problem. But the good news is that wage growth is moderating. At the peak, it was 22% for the rural workers. Now it's down to about 16%, and we expect it to decelerate going forward as the new government tries to not really mess up with that scheme and try to reactivate it further. So that's one. And second is that I do think that the government will hopefully keep expenditure in control. See, India doesn't have a developed world kind of problem where it has to actually cut expenditure. You have to slow the expenditure growth. In April to December, the government had expenditure growth of 17.5%. We know that there is deferment of payment and accounting jugglery which gives you a lower fiscal deficit, but underlying expenditure growth was very high because this was the last year before the elections. But going forward, you will have to bring that down to about 10-12%, which is not an unreasonable amount to expect.
What is the expectation this year itself? Because as you said, there could be a little bit of unpaid
I think what
bills.
we expect is by March 16, you would see inflation moderating to around 7.5%, which gives you a comfort that for the first time in as many years, in fact, in
March 16, not 2015.
Sorry, March 15. Sorry, okay. March 15. March 16, we are at 6%.
Okay.
And what we are also highlighting is when it goes to 7.5% and 6% by March 16, it will be the first time in 8 years that you would have got that inflation closer to RBI's comfort zone. So I think that's a key message that one needs to observe, that it's going to be a slow transition, but I have great certainty that this is going to go there.
Okay, one more immediate question. Since you're expecting the March inflation, 2015 inflation to go down towards 7.5%, what is the Reserve Bank's action by way of rate cuts? Are you expecting any at all by March 2015?
We're saying that there is a good chance that you get one rate cut by March 2015. But I think what we're saying is around that period, you'll get one rate cut. Maybe it's March 15 or June 15. But around that period, you get one rate cut.
But does the 10-year yield fall from these 8.7 levels at all? What is the trajectory?
10-year, and I would urge you to do some more work on it, but nobody talks about it. And it's like I'm probably the only guy who's thinking about it. Just plot the proportion of government borrowing which was getting funded through open market operations. That's gone. 30 to 40% over the last 3 years was getting funded through open market operations. So in a country where you are forecasting GDP growth to go to 5.5, 6, whatever the number may be in 12 months' time, why should the yield curve be flat? Right? Okay. So if the yield curve normalizes, the 10-year is at a fair level right now, and inflation is going to go down, but we're not talking about 3% inflation. So my guess is that one is that this active purchases which were happening by RBI is gone, so that discount which was happening or 10-year was below equilibrium is returning to equilibrium. And secondly is that you do have still somewhat high inflation. So I think that's why 10-year is not responding to...
Fair point. And if, as you point out, the Reserve Bank is not buying bonds, then that itself is a big reason why we should see inflation.
Absolutely. It was trading at an unfair levels, and RBI's response at that point of time is that we need to inject liquidity, and this is the only liquid paper. So they understood that this is a problem, and now they've tried to address it by putting term repo in place and actively withdrawing by not doing open market operations.
Fair point. So that are the serious long-term tangles that are getting untangled at this point in time as Chetan Ahia sees it. So this is, of course, a report which is looking at the next 10 years, seminal changes expected in the economy, and you can see all that in our flashes. Chetan Ahia, thank you very much for joining us and detailing this report in a brief way. We leave the market